Hello, and welcome to the latest in Fitch's series on the global economy. Today, Europe and the global economy. I'm James McCormack, head of the Sovereign team, and today I'm joined by Brian Coulton, Fitch's chief economist, and Ed Parker, head of EMEA Sovereigns. Gentlemen, let's get started. Brian, let's start with you. I think it makes sense to give us a global, sort of a regional macro picture first to set the scene. So where are we in terms of European macro story?
The Eurozone growth story looks very solid to us. We think growth is going to be about 2.5% this year. That'll be the strongest for over a decade. We have seen some weakening in some of the survey indicators in the first few months of this year. The PMIs have come off. Some of the industrial production numbers have been a little bit weak, but we're at the moment putting more of that down to noise rather than signal. We think there's probably some weather-related effects in there. And the industrial production numbers, dominated by Germany, are very volatile. When we look at the fundamentals, they still remain pretty strong. There are three key drivers. On the consumer side, we have very good labour market performance. Job growth has been very strong. The quality of job creation is getting better. More long-term contracts as a share of overall job creation in France, for instance. So that's supporting the consumer. We think investment prospects are brightening. The credit cycle's improving. Firms are getting more confidence. And then on the external side, global demand has picked up. That's been a big factor in the Eurozone. Net trade has been a big positive for growth in 2017. We think we'll see something similar in 2018. When we look at the breadth of the recovery as well, it's quite impressive. All of the countries and a lot of sectors are all seeing simultaneous improvements in growth. So that's telling us that there's some common drivers here. ECB monetary policy is probably an important part of that, but it also means that there is momentum. So it all adds up to a pretty solid picture. We think for the Eurozone.
You mentioned investment spending. I want to circle back to that for a second. So how important is capex and private sector capex in driving this growth story?
Well, capex, interesting, was one of the laggards in the Eurozone recovery after the 2012 crisis. We had the consumption numbers, were looking better quite quickly, but capex was really sluggish up until I guess about 12 months ago. What we're seeing is the numbers looking better across the board, across the big economies. The last 2 or 3 quarters we've had good capex figures. We think that the recovery in bank lending to the private sector is important for that, partly because of the role of the SME sector, small and medium-sized enterprises, which don't have capital market access. Their funding comes from the banks, so the fact that the banks are lending in is pretty important. SMEs account for about 50% of capex. So the credit cycle, monetary policy, I think is very important. We're also seeing rising capacity utilisation rates, so that's putting pressure on firms to invest a bit more. There's less slack in the labour market to absorb as well, but I think more generally there's clear sign of confidence. So that the positive growth surprise that we saw in 2017 is now feeding through in a sort of traditional kind of accelerator way into stronger capex. Overall, the financial position of the Eurozone corporate sector looks pretty strong. We think that this recovery is probably going to be robust, even to some pickup in market interest rates in the next year or so.
Okay, so Ed, we've heard a very favorable macro backdrop. Where does that put us in terms of the sovereign rating cycle? Where are we in the rating cycle?
Yeah, it's a very supportive backdrop to European sovereign credit ratings, and we've seen some pretty strong upward momentum in recent months. So since the beginning of 2017, we've seen 40 notches of upgrades spread across 11 different countries in Western Europe and also Eastern Europe. And now we have 10 sovereigns on a positive outlook and just 1 on a negative outlook. So that's saying that we should expect further net upgrades over the next 1 to 2 years. And I think what's really driving that, as well as the strong economy, is that we've seen improvements in current account balances, so current account surpluses in many countries, declining levels of net external debt. We've seen stronger fiscal balances, some decline in government debt to GDP in some countries, a strengthening in some banking sectors and falling unemployment. So a strong economic and financial position. But I think just one note of caution is that we still have pretty elevated levels of public debt in many countries, in particularly Western Europe. So when we get to a slightly less favourable point in the economic cycle, when growth eases back a bit and interest rates rise, then that's going to be a bit more challenging for sovereign credit.
Okay, and so presumably some of those 10 countries that are on positive outlook also have rising government debt levels as well. So it's not necessarily preventing rating upgrades at this pace, but may do in the future.
It's not preventing them, but we have seen in many countries that government debt to GDP has peaked. Not all of them, but most of the countries in Europe now. But looking further ahead, I think that's going to be a big constraint on further rating upgrades.
Okay, so positive rating story to go with the positive growth story. Brian, I'm going to circle back to you and talk a little bit about the inflation outlook and what you see there.
I mean, you'd expect with better growth that we should be seeing, quite a turnaround in inflation, but we're not really seeing very much of that at the moment. Core inflation is still very low in the Eurozone at 1%. And I think what the evidence is kind of increasingly tell us, and this is becoming an important part of the ECB's own messaging as growth gets better as well, is that there's probably a little bit more spare capacity in the Eurozone economy than maybe some of the earlier estimates were suggesting. When we look at broader measures of unemployment than the headline rate, which take into account people that are working part-time that would be like to work full-time, for instance, that suggests that there's still a bit more slack on the labour market side, there is maybe some evidence that some of the labour market reforms which have been introduced into the Eurozone over the last few years are also holding back wage inflation, which has really not picked up very much. So the rise in inflation that we're expecting is it's going to be gradual, but we still think it's going to happen, and that's important. We don't think that the Phillips curve relationship is dead. We think it's probably flatter than it has been in the past, but we do think as these growth rates we're getting in GDP are well above potential. So that slack that's there is being diminished quite quickly. And so over a medium-term horizon, 2 or 3 years out, I think we can be confident that inflation is going to rise, and that's obviously important for the ECB.
How about over a shorter-term horizon? What do we think the ECB is going to be doing later this year?
Well, as I say, the ECB's messaging recently has turned a bit more to saying that there is quite a lot of slack still in the system, maybe a bit more than everyone previously thought. They're also talking a little bit more about the impacts of the recent strengthening of the euro. Might be holding down inflation in the near term. So it's sort of 2019, 2020 before inflation gets back to 2%. But I still think that means that the 3 criteria which they've set for ending asset purchases, which is convergence to 2% being their expectation for the medium term, confidence that they can stick at close to 2% for a while, and that return to 2% is resilient to them stopping the asset purchase program. I do think that they're going to find themselves in a situation Q3 or Q4 of this year where they feel confident enough to cease asset purchases, and that's our expectation. We get to September, and that will probably be it in terms of the asset purchases. We're already seeing in terms of their messaging, they're talking a lot more now about it's the size of the balance sheet that matters for the monetary accommodation in the system, and they're talking more about when interest rates might go up after that. So they're already trying to divert the market's attention away from the 30 billion flow at the moment. So I think they're definitely manoeuvring themselves. They're being very, very cautious about it, but I think they will get there. I think we'll arrive at a situation in September or October where they feel that they can cease asset purchases. That's a big change for global markets, right? I mean, the ECB have been buying a huge amount of sovereign debt, probably 3 times the amount of issuance, and that's had a huge impact on, for instance, compressing spreads in the peripheral countries across the Eurozone. So it's a big market change coming if we're right on that.
Okay, interesting perspective to lead us into a couple of country-level discussions. Maybe we could start with Italy. I think it's a country that's topical given the recent election non-outcome, I guess you could say. It's one that investors have asked us about a lot, and we think about some of the issues that we've spoken about, high levels of debt and then a change in ECB policy. So what's our current thinking on the Italian sovereign?
Yeah, there's quite a lot of uncertainty over Italy at the moment. We think it's going to be difficult to form a stable government there. The elections, which gave rise to a big increase in support for the Eurosceptic and populist party, the Five Star Movement and Lega, we think it's going to be challenging and protracted to form a coalition. It's just unclear to what extent the parties can converge their policy programs to form a cohesive government. So pretty much all options are on the table in terms of different combinations of coalition governments. There could be a minority government, a caretaker, technocratic administration, or early elections. So I think what that means in terms of policy making is really, a few things. One, I think much less conducive environment for structural reforms, if anything, perhaps going in the opposite direction in terms of boosting growth. Secondly, a bit of fiscal loosening. Thirdly, less cooperation with European partners. But although there's a lot of concern about the rise of Eurosceptic parties, no parties in Italy are really actively talking about leaving the euro. So I think that's not something that we need to worry about too much at the moment. In terms of our rating, well, we did downgrade Italy last year to BBB with a stable outlook, so one of the few countries in Europe where we actually downgraded. So there's quite a bit of tolerance built into the rating at the moment. So for us to be thinking about further negative action, then we'd really need to see a worsening in the economy, worsening in public finances, more problems in the banking sector, or a marked deterioration in political stability.
Okay, and if there is no government say by the end of the year, what does Italy do in terms of setting next year's budget? How does that process work in terms of getting a 2019 budget in the absence of a sitting government?
Yeah, well, I think for this year the budget is sort of taken care of. The sort of previous parameters will continue, but I think to roll over that to next year would be pretty problematic to really have a budget on sort of automatic technocratic settings for 2 years. So I think that's why, for this year we could see things continuing pretty much on track, but next year we think there will be some loosening of fiscal policy, perhaps some tax cuts, some increase in spending, and we're very doubtful that this so-called VAT safeguard clause would be implemented. So unless we get a stable government in Italy, and perhaps even if we do have a stable government in Italy, we expect to see some loosening in fiscal policy next year.
Okay, thanks. I guess we can't really talk about Europe without talking about the UK and Brexit and what our thoughts are with respect to how all that may unfold. So lead us through a discussion on Brexit. What are we thinking there?
Yeah, our current base case is that the UK will be able to agree a free trade agreement with the EU, and that there will be a transition period leading up to that. But there are still substantial downside risks. We could still see an acrimonious no deal, for example, if there's a lack of compromise over this intractable problem of what happens with the Northern Irish border, for example. If that were to occur, then we would expect to see some substantial short-term disruption to the UK economy. We could have lorries backed up at new customs posts. We could see fragmentation of the European supply chain. So there could be pretty big short-term hiccup to the UK economy. Another scenario which I think remains a possibility is that the UK could still stay in the EU customs union. There will be a vote in the UK Parliament coming up, which is going to be a pretty close run thing. If the UK government were to lose that, then I think it would make it difficult for Prime Minister May to continue. We could then see new hard Brexit leadership at the ruling Conservative Party. We could see early elections, so just more political uncertainty. So still many options that we could see in terms of Brexit taking shape.
Okay, Brian, I'm going to draw you in to talk about the UK economy a little bit. In terms of Brexit, I think the expectation was things are going to be quite bad quite quickly, and it hasn't really turned out that way. So why is that? Why didn't the UK economy respond more disfavorably, if you will, to the Brexit outcome, the referendum outcome at least?
I think there's a couple of reasons why the economy was more robust than we anticipated. I think the external environment was a big factor. The strength of the Eurozone economy took us a bit by surprise, and the world economy. I mean, we made big upgrades in our world forecast, and all the numbers essentially started to get better second half of 2016. So in that sense, it was quite a fortuitous time for us to have the vote and have this disruption when the world was getting better. But I think that's been quite important in terms of supporting UK exports, but also allowing, it's also boosted business investment in the UK, which we thought was going to be the area that was affected most quickly. The other thing is we were a bit surprised about how, although the UK consumers slowed down, the slowdown was not that intense, and it seems that the UK consumer, despite suffering a big real wage shock as sterling depreciated and UK CPI inflation went up faster than wages, that real income shock, they offset that quite aggressively by running down their savings and building up quite a lot of debt actually. So there was a little bit of a consumer credit boom happened in 2016, 2017, which again has allowed the economy to be a bit stronger than we thought. I guess going forward, on the consumer side, there's opposing forces. I mean, real wage growth should improve now. We're seeing headline inflation come down now quite sharply in the UK. On the other hand, the consumer's in a less favourable place from a financial perspective. We've got the first financial deficit for the household sector in the UK that we've on record. Household investment is now larger than household savings. That we've never seen that before. So it leaves the consumer, with a pretty limited set of buffers to any future shocks. So those two things offsetting each other on the consumer side. I guess the uncertainty about Brexit has been reduced a little bit by this sort of agreement in principle for a transition. I mean, that was the big concern that we'd get to March 19 and there would be no kind of bridge to enable us to put all the various regulations in place. So that I think has probably maybe eased a little bit of the pressure on business investment. So net probably outlook looking a little better than we thought before.
Okay. And maybe we'll conclude by talking about Eurozone reform or EU reform, whichever one you want to address, Ed. There's a lot of different proposals from different countries. Doesn't look to be a lot of agreement yet, but maybe it's early days. How do we think about that from in general terms and then from a rating perspective? Does it matter? Is it an important consideration for us?
Yeah, it's quite a hot topic at the moment in European policy circles, and there's agreement that some reform to the Eurozone architecture would be desirable, but I think that's pretty much where the agreement seems to stop. So there's a hope of reaching some kind of deal at the June EU summit, but our view is that it's going to be very difficult to achieve that, and we expect very sort of gradual incremental improvement. And that's really because there's just no consensus. You have essentially two camps. You have those who favour risk sharing, led by the French and the more southern European countries, and then those who favour risk reduction, led by Germany and the northern European countries. And the sort of areas that are really on the table is deepening banking union, reforming the European Stability Mechanism, the EU bailout fund, whether there can be construction of some kind of small EU counter-cyclical sort of budget stabilisation mechanism, and then talk of creating some kind of EU-wide bonds, safe bonds. We think that's all going to be very difficult. Maybe banking union is the area where there's most potential for some kind of agreement. In terms of ratings, well, if there is an improvement in the Eurozone institutional setup that increases the resilience and stability of the Eurozone, makes it better able to cope with future shocks, then that could be positive for Eurozone ratings, particularly for those in the Eurozone periphery. But as I say, I think there's still a long way to go. And I think one other thing is that politics is going to remain really the Achilles heel of the Eurozone, because no matter what institutional architecture you have for the Eurozone, if countries elect leaders that say they want to leave, then there's nothing that can be done to keep them in the Eurozone against their will. Or if you have recidivist countries that are implementing policies that are just inconsistent with membership, then the ECB and other member states are not going to provide unconditional, infinite financing for them. So that's why for us, political risk is going to remain an important part of our Eurozone analysis.
Okay. Brian, did you want to
maybe just one follow-up on that point? You know, just the importance of politics. And one of the reasons we're more optimistic on the European capex outlook is that the political uncertainties seem to have fallen quite a lot, and there's a lot of evidence that does matter a lot for firms' investment intentions. If the politics flares up again and becomes a problem, you know, it could feed through to that capex recovery quite quickly.
Okay, a lot of complicated issues. It sounds like we're going to be discussing that in future conversations. For today, thank you very much for your insights, and thank you for watching.